What should I read into the data?
Yes, it's maybe a surprise that the index has increased slightly. And what's behind that is a negative reading coming from manufacturing. As one would expect, manufacturing companies are concerned about their export prospects. They are concerned about the trade war, about the uncertainty caused by the U.S. Trade policy caused by Donald Trump. At the same time, we have positive readings from domestically oriented sectors, in particular construction. Companies are hoping that the infrastructure package announced by the new government will increase demand and will stabilize construction activity. Some positive readings also from the service sector, and therefore overall even a slight increase despite all the turbulence.
Does one offset the other?
Basically, yes, the good readings offset the bad readings. So the overall index has increased slightly, not by very much, but that's certainly more than was expected.
The president of the Bundesbank was speaking to Bloomberg yesterday and talking about the risk of a recession in Germany as a result of tariffs. Does your data tell a similar story? Is that the narrative you're hearing from German business?
Yes, I think our data maybe is a little bit more positive. At the same time, we have to see that the baseline for the German economy is that it's stagnating. So a small negative impact would push it into recession. So we are very close to the zero line. So, for instance, an escalation of the trade war could push Germany into recession. That's true.
Do we have something of a duration mismatch when it comes to the German economy? You obviously have the near-term risk of tariffs and the longer-term opportunity that comes from the higher fiscal spend. Are we in danger of conflating that timeline, i.e. we're seeing them both as being at the same time, and actually in some ways we shouldn't? The near-term risk is tariffs, the longer-term, and it is a longer-term opportunity, lies in fiscal.
Yes, maybe what's stabilizing in the short term as well is the decline in interest rate we've seen. It seems that capital markets perceive Germany maybe as a safe haven in this situation to some extent, as the US is considered more risky, and that does stabilize the economy even in the short term. But of course, the trade war is a huge short-term risk, and it's not entirely clear that these more medium-term fiscal programs, fiscal expansion programs can compensate for that. They may come too late. At the same time, investors who think about doing construction projects may bring them forward maybe because they think, okay, in 2 years there will be a lot of demand, rising prices in construction, so there could be a stimulating effect in the form of anticipation effects.
That's interesting. Worrying about maybe the shortages of materials being kind of a factor. How do German companies feel about a stronger euro?
That, I suppose, adds to the concerns about competitiveness, the concerns about exports. In the survey, manufacturing companies are telling us that their export prospects are negative, and the increase in the euro adds to that. What was expected was certainly the opposite, so a decline of the euro versus the US dollar, and that hasn't come out because it seems that capital markets seem to be driving this increase in the euro.
Clemens, just very briefly, how big an impact would a lower cost of capital have on the German economy if rates do continue to fall?
It will certainly have an impact on construction and on residential construction. Residential construction has been very low in Germany, and that could be an important factor stabilizing that. So overall, a positive effect. Maybe less of an effect on manufacturing investment because there it's the uncertainty that's holding back investment, not so much the interest rates.